welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Mutual funds, perhaps the simplest road to investment in both the equity and the debt market. While we all know the benefits of investing via mutual funds, the choices and the multitude of schemes can leave one quite confused. So this episode of Money, Money, Money is dedicated to answering the many queries that we keep getting on mutual funds. Well, joining me on the show today is Mr. Srikanth Meenakshi, co-founder and COO of fundsindia.com. Meenakshi, thanks so much for coming in. It's great to have you on the show.
Absolutely.
And you've flown in all the way from Chennai, so you're a special guest. Thanks very much for being here. You know, before we get in the callers and the queries, and there are lots of them that we've been getting over the last couple of weeks, I just want to look at your approach to investing via mutual funds. The eternal question always comes to mind is that in this financial year, if I have a certain amount that I've decided, should I, right now looking at the market, put in the entire money or should I stagger it out? Are you an SIP follower or do you think lump sum investments also have their merit?
Well, lump sum investments do have their merit, but in very specific circumstances. If you're investing for, let's say, 10 years, 15 years, really long-term horizon, right? Long-term investment horizon. It doesn't matter if you're going to stagger your investment for the next 12 months or if you're going to put it in one lump sum today and wait for the next 10, 15 years. I mean, the amount of market averaging you're going to be doing relative to the
long-term return
of the investment, it won't really matter. But if you're investing for, let's say, 4 years, 5 years, or even 7 years, something of that time horizon, it will definitely you'll do well to invest in a staggered manner. My approach has always been, take about 10 to 20% of the time frame and complete your investment by that time. Because if you're not completing your investment by this time, then the time that your money is spending in the market, you'll be compromising on that. You don't want to do that, right? So if you're investing, for example, for 5-year duration, you have to stagger out your investments and complete investing your money within, say, 1 year, which is like 20% of 5 years. So all your money will get to be in the market for at least 4 years, and you can hopefully get a decent return at the end.
Okay, so those are some thumb rules of how to deploy money. Let's come down to now the choices themselves, and there are so many of them out there. So why don't you start by giving us some of your top picks? So let's break this down. Let's talk about the basic blue chip equity funds, and then maybe some mid-cap ideas, and certain high-growth funds where, the choice of companies is usually a little more on the aggressive side. How do you decide? What are the parameters that you follow, and some examples?
Sure. See, at Funds India, right, we have this thing called the Funds India Select Funds. And a tremendous amount of work goes into choosing the funds that belong in the Funds India Select Funds list. And the most important criteria that we look at, and we look at it from different angles and different dimensions, is the risk-adjusted return, right? The fund manager takes a certain quantum of risk in the portfolio that they're managing, and commensurate to the risk that they are taking in the portfolio, are they delivering the returns? This is the most important parameter that we look at, but we look at it from different dimensions. I mean, from a rolling return dimension, from the risk measure dimension, from category averaging, and from how it compares to its peers, how it compares to the benchmark, how it compares to the market, how the fund manager did in a growing market, how the fund manager was able to contain losses in a down market from a different point of view. But we look at this parameter of risk-adjusted returns.
Obviously, it's far more comprehensive than just looking at 3-year or 5-year fund returns, which is what a layman on the street can actually do. So now that you're, of course, deploying a lot of these parameters and categorizations, run us through the winners, so to speak, in different fund categories as well, and what sort of funds do you like at the moment?
At this time, we are a little partial towards the large cap funds. I think, large cap funds have potential to deliver over the next few years. And I'm not going to take a short-term approach and say, invest in it for the next 1 year or 2 years or something like that. But over the next few years, I think the large cap stocks and large cap funds, consequently, have pretty good legs to stand on, and a pretty good choice for the investors to invest in at this point of time. Okay,
so your top large cap bets then? In terms of fund picks?
A perennial large cap fund is Franklin India Blue Chip, and you also have Birla Sun Life Frontline Equity Fund and ICICI Pro Focus Blue Chip Fund. These are No surprises there, really. I mean, these are pretty good, well-established funds. And in the blue chip category, the blue chip category of funds, you don't expect surprises. You don't expect some fund to suddenly do spectacularly well or something like that. So these three funds, which have been good for investors for quite some time, they are up picks right now.
And since you mentioned the slightly medium term, so if you're looking at the next 5 to 7 years in these funds, what's the realistic rate of return you can expect?
It's a tough game to play, but I'll play along with some caveats, obviously. Large cap funds, you can expect between 12 to 15% returns if all the stars align and markets cooperate and all that stuff.
Fair enough. So that's all about large cap funds. But there are people, of course, who are looking at equity to be more aggressive in their portfolio. So they'll look at mid cap companies, mid cap funds, micro cap companies, micro cap funds, and the high opportunity or the fast growing company funds. So therein, how do you sort of adjust for the risk, and what are again some of the top choices that come to mind?
Well, we don't really adjust for the risks in this situation, but we do recognize that the fund manager has consciously, voluntarily taken more risks, and we evaluate the performance based on the commensurate to the risk that the fund manager has taken, like in other equity funds. In this space, we like BNP Paribas mid-cap fund, as well as the two other funds which are pretty good funds which have been pretty good funds for quite some time now. HDFC Mid-Cap Opportunities Fund and ICICI Pru Value Discovery Fund. And in the smaller cap space, we like Mirae Asset Emerging Blue Chip Fund, Franklin India Smaller Companies Fund, and a fund that's been doing quite well recently, the DSP BlackRock Microcap Fund.
So, and what is it that you like about them? I mean, is it the absolute rate of return ends up being the highest in terms of the comparisons that you've drawn up?
They have done well. They have returned well relative to the risks that they have taken, and within their
How is this measured? Because you keep coming to this point of, relative return or return relative to the risk that the fund manager is taking. How does this get measured?
There are different measures for this. The most popular measure, or the most well understood measure of risk, is the standard deviation. Okay, how volatile the fund's performance has been, and relative to the standard deviation, how the returns have measured up for a particular fund. In this category, for example, I mean, we spoke about two different mid-cap fund categories, right? One mid-cap and the other smaller micro-cap.
Small cap, micro-cap, yeah.
Obviously, you can see that, the DSP BlackRock Micro-Cap Fund will organically, because of the nature of the portfolio that the fund manager has put together, will have a higher standard deviation, and we'll evaluate that fund, and we will say, has the fund manager delivered returns commensurate with that amount of volatility that this fund is exhibiting.
Okay, well, we've got nicely warmed up with this initial conversation, so let's take a break. We'll start answering your questions on the other side.